The stock market is currently closed, and as of the last trading session on July 2, 2026 at 4 p.m. Eastern Standard Time, Super Microcomputer Inc., trading under the ticker symbol SMCI, finished at $27.22 per share, marking an intraday decline of 1.56% on the day. While most casual market participants look at this steep, multi-month drop from its historical highs as a simple deflation of hypergrowth technology multiples, the real mechanics at play are far more complex and hazardous. The immediate factor setting up a massive structural divergence is that while retail investors are watching the charts waiting for an automated bounce, an international regulatory dragnet just intensified, with Taiwanese authorities raiding the company's local branch offices in late June over allegations involving unsanctioned hardware shipments. This latest legal escalation directly clouds a massive $39 billion customer backlog, meaning that the absolute valuation of the firm is no longer being decided by server demand, but by severe legal counterparty risks that could disrupt their entire hardware procurement line. The broader expectation floating around online forums and popular investing sites is that the massive computing boom will naturally lift all boats, positioning this enterprise as a permanent pillar alongside titans like Nvidia stock or Apple stock. People opening an individual brokerage account or using basic online investing tools often assume that a trailing triple-digit revenue surge guarantees long-term appreciation, viewing the current correction as an obvious bargain. However, the reality hidden beneath the headline growth paints a dramatically contrasting picture. When you filter out the raw volume of orders and look closely at the operational execution, the profit margins are shockingly thin, with gross margins hovering around 8.4% over the past year. This reveals that the firm is essentially operating a high-volume, low-margin logistics and assembly business rather than retaining high-value intellectual property pricing power. For everyday traders managing their capital through self-investing methods or automated systems like Schwab Intelligent Portfolios, this tension between massive top-line orders and minuscule profit safety margins creates an incredibly deceptive setup. Looking deeply into the recent trading dynamics reveals a heavy institutional exit disguised by volatile retail buying. Throughout May and June of 2026, the trading volumes surged dramatically, often exceeding 40 to 50 million shares per day, culminating in a chaotic trading session following the international office raid, where nearly 91 million shares changed hands. Institutional liquidity providers utilizing advanced interactive brokers' trading models have steadily reduced their exposure, rotating capital out of high overhang hardware suppliers and moving towards stabler tech assets or diversified fidelity ETFs. This massive selling pressure has repeatedly pinned the equity down, creating a technical consolidation pattern that resembles a precarious double bottom between the $27 and $28 territory. While visual charts on popular retail applications like the Robinhood app suggest a technical floor is forming, the underlying capital flows indicate that institutional funds are using short-term counter-trend rallies to unwind larger positions. This behavior stands in sharp contrast to the aggressive accumulation witnessed in secular favorites like Tesla stock, highlighting a deep skepticism among sovereign wealth funds and large asset managers regarding corporate governance. A major variable that completely altered the balance of supply and demand for this equity was the recent closing of a massive $7 billion capital raise. To put this in perspective for anyone using a standard individual brokerage or checking their portfolio balance on the SoFi trading platform, a capital raise of this magnitude introduces massive shareholder dilution that structurally lowers future earnings per share metrics. Management heavily relied on this massive cash injection to fund their immediate components inventory and handle working capital constraints, but the dilutive impact means that even if net income grows significantly, the slice of the pie belonging to each individual share is noticeably smaller. This dilution explains why the stock trades at roughly 0.53 times next 12 months enterprise value to revenue, a steep discount compared to traditional server competitors like Dell or Hewlett-Packard Enterprise, which trade at significantly higher multiples despite growing at a slower pace. The equity market is effectively pricing in a major operational structural breakage, warning that a hardware assembler operating on single-digit gross margins cannot easily withstand prolonged compliance investigations or potential supply chain blacklisting. For retail investors navigating these turbulent waters, choosing where and how to execute trades has become an essential part of defensive risk management. Many younger market participants rely heavily on Robinhood stock trading features, utilizing modern tools like Robinhood fractional shares to accumulate positions, or keeping uninvested cash in Robinhood cash management accounts to yield interest while waiting for clarity. Others look for more comprehensive institutional access through the Interactive Brokers platform, which provides deep data on short interest and international market settlement, which is particularly useful given the international nature of the latest Taiwanese regulatory developments. For those seeking structured investment help or looking to build a long-term retirement safety net, relying on premium packages like Fidelity Investments or setting up specialized Fidelity IRAs can offer a more balanced approach through curated Fidelity mutual funds. The modern digital landscape offers everything from completely autonomous self-investing to highly structured managed accounts, but no platform can insulate an investor from fundamental corporate vulnerabilities if the core business model begins to experience structural degradation. To understand how the business model reached this critical inflection point, it is necessary to examine what the firm actually builds and how its operations became so thoroughly intertwined with the broader semiconductor matrix. The company specializes in designing and building high-performance server solutions, optimizing complex clusters of hardware for cloud providers, data centers, and enterprise environments. Their core competency lies in their modular server architecture, which allows them to assemble custom server racks rapidly based on the specific needs of their corporate clientele. As the demand for rapid computational processing escalated, their direct relationships with key chip manufacturers allowed them to source cutting-edge accelerators faster than slower, more traditional hardware manufacturers. This agility resulted in an unprecedented spike in revenue, causing many retail traders using general investing sites or basic online investing apps to assume that the growth trajectory would remain perfectly linear forever. However, assembling third-party chips into sheet metal chassis and configuring liquid cooling loops is a fundamentally different business model than fabricating the silicon itself. The chip providers retain the supreme pricing authority, leaving the assembly partner vulnerable to sudden price increases and supply reallocations, which directly depresses corporate profit metrics over time. This structural margin pressure is exactly why the upcoming fiscal fourth quarter earnings release scheduled for early August 2026 has become an absolute battleground for the bulls and the bears. Wall Street analysts have established a highly cautious consensus, with the vast majority maintaining neutral or hold ratings, and the current breakdown sitting at roughly 11 holds against only a small handful of aggressive buy recommendations. The street consensus price target has drifted down towards $37, which reflects a complete recalibration of expectations compared to the euphoric predictions seen a year ago. Traders executing strategies via SoFi investing portals or tracking multi-asset movements on the Fidelity trading platform are looking specifically at whether the company can successfully expand its gross margins back into double digits. If the upcoming financial report reveals that margins have slipped back towards the 8% mark, it will provide definitive proof to short sellers that the company cannot convert its massive sales volume into meaningful net earnings. Conversely, if management can demonstrate that their liquid cooling architecture is commanding a premium price point, it could catalyze a swift short squeeze across major trading platforms. Comment below how many shares of Supermicro you currently hold in your individual brokerage account, and whether you plan to buy this dip or completely rotate your capital into safer tech giants. Navigating this environment requires understanding the different scenarios that could play out over the coming months. In a best-case scenario, the independent internal investigation into the company's accounting practices and regional shipping activities concludes with no findings of systemic wrongdoing, allowing the legal overhang to lift entirely. Under this narrative, the massive $39 billion backlog gets delivered on schedule, margins stabilize as manufacturing scales, and the stock rapidly re-rates towards its historical averages as institutional capital flows back via Interactive Brokers stock networks. In a worst-case scenario, the regulatory investigation intensifies, resulting in formal compliance penalties or restrictions on their ability to procure advanced components from major chip design firms. Because their business model depends entirely on immediate access to cutting-edge chips, any disruption to their procurement timeline would immediately invalidate their forward guidance and lead to severe cancellation of customer backlogs. For self-directed capital allocators utilizing tools from SoFi Active Investing to Advanced Fidelity Wealth Management Consulting, managing this binary risk profile requires an intense focus on actual corporate disclosures rather than speculative social media hype.